Assets, liabilities, terms that are thrown around a lot in the investment world. What do they mean? Well, let's get into it right here, right now. For yourself, asset, liabilities, your own personal balance sheet. Let's break it down this way. Assets is everything you own that has a value. So obviously, we'll start with your biggest asset. Maybe you own a home or a condo. Maybe you have a rental property. Maybe you own vehicles, a motor home. Maybe you own an investment portfolio, RRSPs, TFSAs, non-registered account, corporate account. Perhaps you also have other assets such as farmland. Maybe you own storage. Maybe you also own collections of art or fine wine, or perhaps a rare music catalog, or maybe you own crypto. Those are all things that'll show up on your balance sheet as asset. On the liability side, think of everything you owe. Do you owe any money? Now on the personal side, that'll typically be your mortgage, your lines of credit, any credit card you might own, maybe a corporate loan, maybe you own promissory notes to individuals about something, but typically that's kind of the list of debt. Car payments, that's kind of the list of loans. So assets, everything you own, liabilities, everything you owe. When it comes to companies, we use assets and liabilities to measure what a company's worth and what their balance sheet is and how financially stable these companies are. They're typically acquired or created through business transactions or through kind of natural evolution of the company. They include both tangible assets and intangible assets, and we'll get into that right away here. Anything that a company can use to produce value, that can be defined, loosely defined as an asset. Typically two types of assets. There's current assets and there's non-current assets. In the current assets, these are assets that can be converted to cash or are able to be converted to cash in the near term, typically within 1 year of an operating business cycle. So that can include cash, inventory, receivables, and short-term investment. Non-current asset, this would be like longer-term assets that you can't just convert to cash overnight. This could include a property, a plant, some equipment, long-term investments like a long-term stock portfolio or long-term real estate investments, and also intangible assets such as copyrights, patents, those kinds of things. You can't just sell those kind of overnight. Now they use 1 year loosely as a definition between current and non-current assets, but those are kind of longer-term assets, whereby cash, short-term investment portfolio, inventory, those are all kind of shorter-term assets that you're expecting to convert to cash short. So assets, they're owned, they're controlled by the business, they produce value, it's expected to generate revenue in the future. They include physical objects and intangible objects, and they show up on one side of the balance sheet. Now the other side of the balance sheet, you're gonna have liabilities. As a company, you have liabilities, much like you and I have liabilities as, adults or kids, they have liabilities. So liabilities are obligations that a company will owe to a third party. So think of it as debt or something. It's a liability. It's something we have to pay at some point. And typically it stems from past transactions, past events, past business dealings, and it usually stuff to kind of operate. Current liabilities, much like the current assets, typically due within a year. And that will include accounts payable, taxes, short-term liabilities, and salaries payable. Longer-term liabilities will be something that's not kind of owed or going to be paid in the next 12 months. That'll include long-term loans, long-term mortgages, bonds that are payable, debentures that might be payable, deferred tax liabilities. Think of money that's owed in the future. Three characteristics of liabilities: they reflect a company's debt and financial obligations. They're settled over time through the transfer of money, typically, and they're crucial for funding and operating a business. And there you have it. Assets on the one side, liabilities on the other, and your balance sheet reflects assets minus liabilities, and your net worth will be the difference. The more assets you have, if you have more assets than liabilities, you have a positive net worth. And if you have the opposite, you're in a negative net worth. If you want to understand how this impacts your personal life or the companies that you're studying on the stock market, or would like some advice on building your portfolio or making your financial plan, go to speaktorob.com to book your no obligation consultation. We'd love to chat with you about this, your personal wealth situation, and how we can help you to build your financial freedom. Thanks for tuning in, guys. I'm Rob Tetrault. I'll see you in the next video.